am.
Way to go,
It's probably very
Sherry.
exciting.
Well, wait with you.
What a community bank.
I meant that the nice way.
Payback.
At least you're not here for a dental appointment.
It is. Thank you. Subject matter there. Yeah.
We knew we do such a good job here, there wouldn't be much to report.
That's right. We'll just get it done and get you out back in the nice weather.
And
I'm busted.
Well, I got
How you feeling today,
No,
Dan?
we can't.
Ah.
Still at the- It's not the official meeting yet.
That's right.
Yeah.
Before we go to the official meeting, which will begin after we hear from auditors about our annual audit report, I would like your forbearance as board members and also the public to realize that we'll hear the audit reports first for our three parts of our agency, and then we will begin our regular meeting at the conclusion of the audit report. So, you're on, auditors.
All right, very good. Well, we'll start with the IDA then. So the pages 1 through 3 are the independent auditors report, and a couple of years ago they changed how the structure of that was, and now in the very first opinion you get your unmodified, in the very first paragraph you get an unmodified opinion. So it puts it right there, so you don't even have to dig through it to find out that you had an unmodified opinion. So very good job. That is saying that the financial statements are fairly presented. And then it goes on to talk about what the basis of our opinion was and what management's responsibility is for the financial statements and the auditor's responsibilities. So that goes on and on. And then there's a section that discusses the required supplementary information. Since the IDA is a government, it's subject to some additional areas, which is a management's discussion and analysis, which is prepared by management. And then there's also some schedules that are required that are related to your pension. And then we also have a section in there, the last section talks about you're subject to a yellow book opinion, and that is a report. It's not actually opinion, but we do look at your internal controls over financial reporting and your compliance with grants, laws, and contracts. So then we get into pages 4 to 11. That's management's discussion and analysis, and it has financial highlights, explains the whole structure of the IDA, the history. It gives an overview of the financial statements, and it has comparative financial information. So in the main financials, it's a 1-year presentation, but in the MD&A, there's 2 years, which are summarized, and they give you the picture there. And then there's also economic highlights, which you've had that Jeremy prepared, and also outlooks for the future. Also, it breaks down your land, building, and equipment quite nicely. So we'll get into the regular financial statements, and they're on page 12. So its statement of net position is first, and that's a picture in time. So at December 31st, 2024, this is what we looked like. Our current assets are $1,059,000, up from last year by about 396. So last year they were 664,000. Our cash and equivalents is 93,000. That's up just about 5,000 from last year's 88,000. Our treasury bills are 940,000, and they're up from about 500,000 the prior year. So together, if you take the cash and equivalents and the treasury bills, we're up about 395,000. And then last year you had 50,000 held with an agent for the deposit on the land that you sold. We had no receivables at the end of the year. Prepaids were about 21,000. They were down about 6,000, and that was primarily due to you sold that property, so you didn't need that insurance on that property anymore. So we didn't have as much prepaid insurance on the leather stocking policy, I believe it was.
Correct.
Our net land, building and equipment was down 431,000 because you sold those two pieces of property, and overall you realized a gain of 54,000. New this year, with your building that you're in now, this is a right of use asset related to the lease. So if you'll remember, we had this with the EDC and the previous the IDA never did have a lease that fit this criteria because you were on month to month. So what this means is we're putting the lease on as an asset, and it gets amortized over the life of the lease. And then it also becomes a liability. So we had $80,231 added for that. And then there was accumulated amortization of $9,360 for the year. Our total assets were $1,337,000, and that was up about 37,000 from last year. Last year was just about 1.3 million even. Our deferred outflows are 106,000. They're up 13,000 from last year. Last year it was 93,000. And then we have our liabilities. Our liabilities are 195,000, and they're up slightly, 23,000 from last year. Last year was 171,000. Our pension liability is 84,000. That's down about 24,000 from the year before, which was 108,000. And 2 years ago, that was actually an asset. So last year we had a very big swing where it became a liability. Our lease liability related to the asset is 72,000. So last year we didn't have that. And it's broken out by the current portion, which would be the next 12 months, and then the longer term portion. We did have a deposit held. It was 31,000, I believe. Last year was 30. Oh, yeah. Last year we had 50,000. So you had put some money away to cover legal. You had received a deposit to cover some legal expenses related to a solar project, I believe. So, and we did spend about 19,000 of legal in there, and that was paid from that reserve. We had deferred inflows of resources were 45,000, and that was up 37,000 from the prior year. Prior year was 8,000. And that leaves our net position. So our net position is 1,203,000, and that's down about 12,500 from last year. Last year it was 1,216,000. So, any questions on the statement of net position? We'll go into the statement of activities. Or statement of revenues, expenses, and changes in net position. Our charges for services this year were 314,000. They were up from last year. Last year we had 21,500, so that's a $292,000 swing, and that was primarily due to the closing on the that testing laboratory. I'm not going to try to say it. That was 176,000, and the ACE development of 108,000. We had total revenues of 454,000. Those were up 345,000 from the prior year. So a lot to do with that, the pilot. We had gains on our sale of property of about 54,000. That leaves our expenses now. We have our total costs were 455,000, and that was up 345,000 from last year by about 110,000. So we had, oh gosh, and then so our salaries were up about 32,000. I mean, sorry, 23,000. Our benefits were up 9,000. Our professional service contracts were up 4,000. Supplies and materials were up 18,000. And we had other operating up to, down 22,000, so that was more of our miscellaneous things. Our change in our net position was a decrease of $12,498. Last year it was a decrease of 325,000, so it was less of a decrease by 313,000, but it was still a decrease in net position. That's it for the statement of activities, and we go on to the cash flow statement. That just gives you what happened in cash. So we had a total decrease of cash over the year, or I'm sorry, it looks like an increase of cash of 396,000. Last year it was a decrease of 213,000. And then we get into the notes to the financial statements, and those go from 5 to 24. Note 1 is our summary of significant accounting policies. That really talks about all your policies that you have in place. It gives some definitions, what makes up, what would be considered, not, I'm sorry, somebody's quickly turning pages here. Our net investment in capital assets, our restricted net position, which we didn't have any, and our unrestricted net position. It also talks about your capitalization threshold. So you're at 2,500 and straight line depreciation. We didn't have any bad debts for the IDA because we don't have any receivables. Compensated absences were just about 4,000, just about the same as the prior year. It talks about the pilot payments. So the pilots just flow through. They're not recognized on your revenues or your expenses. And those were about 486,000 that flowed through during the year. And then we get on to note 3 is our capital asset, and that breaks down what happened with our fixed assets. So we did have disposals of 800, well, we had disposals on land of 58,000, construction in progress of 34,000. We had buildings and improvements of, and furniture and equipment of about 800,000 that we disposed of. And some of those weren't fully depreciated. So you had kind of a loss on one and a gain on the other. So it netted out to be an overall gain of 54,000. And then also we have our right of use lease asset of 80,000, and we've got accumulated amortization of 9,000. So that will go, that amortization, accumulated amortization will increase every year until we're done with the lease. And that's a 5-year lease, I believe. And our notes 4 is on our retirement system. So we had a liability this year. You want to talk about the
Sure, I could chime in. So, as you know, we belong to just one retirement system. It's a New York State ERS system. And we have a small chunk of that system. So we get the disclosures and the numbers are provided to us from the ERS audit that they have done. And when we do that, so you're at the end of the year, you had pension expense of 37,407. That is your percentage of the entire pension expense. And as Pam pointed out, you have a liability this year. So the value of the assets in the whole pool are slightly lower than the value of than the liability for the whole pool. So you end up with a small liability of, I think it's 83,479.
83,000. Yes, yes.
Yeah, on that one. So that can swing depending on the investment. So
yep. And 2 years ago, that was actually an asset.
right. So, and there are also other things involved called deferred outflows of resources and deferred inflows of resources that are related to that. Mostly those are changes in the actuary assumptions in there. So they kind of write those off over a period of time. The actuary does. So you can see there'll be some swings in those depending on what the changes are. And those changes could be the assumptions on how long people live. Those tables change and were updated recently. So those assumption changes can have repercussions for whether it's a deferred outflow or deferred inflow. So we just report our little chunk of that.
And then it actually talks about on page 24, it's interesting. It gives the whole entire system pension and liability, and then your portion up next to it. So that's kind of a neat breakdown, and it's actually funded 93.88%
Right.
for that year.
That's pretty close to 100%, but they're not quite
So
there.
that's the most extensive note. Note 5 is commitments and contingencies. And you did receive a $50,000. I mentioned the deposit to cover legal costs, and at the end of the year, it was 31,000 was unspent. So that is recorded as a liability. Note 6 is our note on the leases. So that gives you the breakdown of that lease liability, what's current and what's due, principal and interest for the term of the lease. So it's up in 2029. And you also have other leases that don't meet that criteria. And then the last note talks about any subsequent events. So if anything happened between the end of the year, 2024, and the date of the financial statements, we would let you know there. And I think last year we had something to say. You had that deposit, you could actually recognize it, that the land sale was going through. And then there's two other schedules after the notes, and that's related to the pension. So there's a schedule of the agency's proportionate share to the net pension liability. So this year we met, we're supposed to give a 10-year history, and this year we're finally at the 10 years. So that was implemented in 2015. And then there's also a schedule of employer contributions. So you can kind of see where that fell throughout the years. And then the last opinion, or the last report in there, is that Yellow Book opinion, where we talk about what would constitute a deficiency in internal controls over financial reporting, what would mean it was a significant deficiency, which that would be brought to your attention, or a material weakness, which would be potential material misstatement of the financial statements if we had anything, but we didn't. So the fact that we have no deficiencies, and that's a short opinion, then, and no schedule that's accompanying it. So that's very good news.
Congratulations on that.
Thank you.
See that.
So if there were more pages after that, we wouldn't want that. Any questions on the IDA? All right. Well, I've got the CDC next, because the IDA and the CDC are also governments, so we thought we'd get the governments out of the way. We have cash and equivalents of $924. Those are down from last year by $7,245. We have treasury bills of $14,564 last year. And we had a receivable for $14,250. Our total assets were $30,000. It was down $316 from last year's $30,304. We had no fee income this year. Last year we had $24,000. We have $734 of interest income. Last year was $479. So you're investing in those treasury bills and obviously paying much higher interest rates. So Paul's done very good job on getting those T-bills, and Jeremy, and investing those and maximizing those good interest rates. We had operating expenses of $1,050. That's up $30 from last year. So it's primarily insurance portion and our audit fee.
That pesky audit fee.
Yeah, some of it.
Yeah, that's the $30.
Yeah, that's the $30 went up. Yes, it did. cash flow statement is also in the CDC, and that decreased $7,245. Last year was an increase of $399. This also has a yellow book report, so again, no deficiencies noted, so clean. So, any questions on the CDC? That one we can actually audit 100%, so we feel pretty good about the numbers there.
Be too expensive.
Okay. All right, well, now we'll go on to the EDC. This is a not-for-profit, so it's not a government. So it falls under different standards. The governments fall under government auditing standards, and the not-for-profits fall under FASB. Yes.
Financial Accounting Standards Board.
So, but we like to just say GASB and FASB. So again, you have an unmodified opinion that the financials present fairly. Same in here that talks about management's responsibility for the financials. So management is responsible for the preparation and fair presentation of the financials, the auditor's responsibility and the standards we use. We also look to make sure that you would continue as a going concern for the next 12 months. And there we would let you know that. Then we actually show this one in a comparative format because we audited it the prior year, but we're not giving it another opinion on the prior year, but we're letting the reader know that we did audit it and it was unmodified opinion, and it's remains the same for the current year. There is a section on whether there's a yellow book report there also, where we look at our internal controls over financial reporting and compliance with grants, laws, and contracts. We have, we'll get into the financial statements. Since this one's not a government, there's no management's discussion and analysis. So you don't get to read all that fun stuff. So they'll probably end up doing that for not-for-profit someday. Some highlights on the statement of financial position. So again, that's what we looked like at December 31st, 2024, with our comparative totals of December 31st, 2023. We had total assets of $2,366,000. That was down $184,000 from last year. Last year was $2.5 million. Cash and treasury are down, are $1,058,000. Those are down $163,000 from the prior year. Our grants and contracts receivable were $179,908, and last year this was $179,480. So just a couple $100 off. Our prepaid expenses are about the same. They're at $5,800. Last year they were at $4,600. Our current loan portion were up $116,000, and our long-term was down $43,000. So overall, our loans receivable were up by $73,000. You assess an allowance for any credit risks, and you look individually at some of the loans, and you have different varying percentages that you calculate, that Paul and Jeremy calculated based on the likelihood of collectability, and you're also looking at historic history with these clients and the industry. So we did increase our allowance to $366,000. That was up $84,000. Last year it was $282,000. So that represents about 25% of the portfolio.
Yeah, I'm just gonna jump in real quick.
Yep.
So part of that calculation we do in-house. And the reason for increasing the potential for on collectibles wasn't directly related to any particular client. It's really more or less was increased as a result of what the potential economic conditions that we might be facing in the year ahead, year or two ahead. So I just felt that we needed to have more of an allowance for potential losses.
I'm so conservative.
I'll second.
Yeah, okay, well, and we had no write-offs in the current year. In the prior year, we had a large write-off, if you'll remember. Our capital assets are 10,000. They're down 11,000 from the prior year. That was 21,000. So when you made the move, you got rid of all this very old equipment that we didn't even have the details of the list. It just said equipment. So we were able to split that out, and everything was fully depreciated at that point. So there was no gain or loss on the disposal of that. Of course, there wouldn't be a gain because you didn't sell anything. So the lease that we did have on there as a right of use lease actually expired during the year, and now you're on a month to month with not the intention to renew it for a long period. So that that just becomes an operating lease. And then our total liabilities are $80,000, which is down by last year's 121,000. That was down 41,000. Our accounts payable and accrued expenses were down about 10,000, and that's just primarily due to timing. Any questions on the statement of net position or net assets? Okay, we'll go on to the statement of activities. Our total revenues were 711,000. They're up from last year by 54,000. Grants and contract income were 520,000. So that was up 61,000 from the prior year of 458,000. And last year's was down because the year before that you had a lot of CARES money. You just had a little bit of CARES last year. And then this year it was primarily your resilient flood program, Ready and Resilient. So we had a lot of grants related to the year end there, and they actually kind of crossed over the year. So we did pick up an additional receivable of that, and then also the payable that's going out to the people that were awarded the grants. So we'll see increases there. Our loan interest income was 82,000, and that was up 19,000 from last year. So last year was 63,000. Our interest income on investing is 50,000, up 11,000 from the prior year. That was 39,000, and that again is the treasury bills. So that used to be just a few $100s, so pretty significant. Our total expenses are 854,000. Those were up from last year's by 83,000. So last year was 771,000. That leaves a decrease in our net assets of 143,000. Last year we had a decrease of 114,000. So we did have decreases both years. This year it was a swing of 29,000. The expenses in there are broken out by program, management, and general on the statement of functional expenses. So that gives you more detail on the natural classification. So we had salaries and wages and fringe benefits overall were down 48,000. So they were 143,000. Our consultant services were up 2,000 from the prior year. Marketing was down about 1,000. Legal was down 6,000. Our office expenses were down 6,000. Our internet and phone were up 3,000, and our occupancy was also up 3,000. Depreciation and amortization were down 4,000. We had grants paid to others were 501,000. So last year they were 361,000. So that was up 140,000. And our bad debt expense, or credit loss expense, was about $3,000 higher than it was the year before. And the year before we wrote off those 2 loans, and then we restored the allowance. So that hits that bad debt credit loss expense area. Our cash flow showed a net decrease of 163,000. Last year, it was an increase of 4,000. So that is it for the statements. And then we get into those notes, which run from 8 to 18. Again, note 1 is going to talk about our significant accounting policies, the basis of accounting used, what makes up net assets without donor restrictions or net assets with donor restrictions. And we didn't have anything that fell in the donor restricted net assets. So that would be if there were donor imposed restrictions that were temporary in nature that would be met by either time or purpose. So we didn't have anything that fell into that. And we talk about your reserve for uncollectible accounts on page 10. So that allowance is 366,000. It was 282,000 the prior year. So it's about 25% of the portfolio. Last year, it was about 20% of the portfolio. Compensated absences were about 3,000 for this as well, very similar to the prior year. You advanced 329,000 in new loans and in fiscal year 24, and in 23 you had 260,000. So the last 2 years we advanced a lot of the loans. I think the year before we didn't have any. So in 2022 possibly. And then note 5 breaks down all of the receivables, all the loan receivables with their balances and the terms. And if there were any adjustments, any amendments, addendums to the loan terms. I think we did have one that stretched out another year. And so our total in there, our total loans receivable are 1,480,000. Last year they were 1,406,000. Our capital assets are again 10,000. So we did have disposal of equipment, and that lease fell off. We note 7, we just tell you again, there weren't any net assets with donor restrictions, but
if there was,
they would be there.
they'd
There
be
would be
there.
there.
That little spot for them.
Note 8 breaks down that lease. So in the previous years, it would have the lease liability with the current portion and then the long-term portion. So that was expired during the year. We did pay interest of $67 on that. Commitments and contingencies, this is pretty much the same as the year before. These are just some loans that where you've had some kind of tweaks to the agreement and what the balances were at the end of the year. So these are kind of seasonal. So you're making concessions for the time when they're not bringing in those regular funds. We didn't have any write-offs during the year. Last year we had those 2, which were 329,000. We didn't have any unearned revenue at the end of the year. Last year we had some grant funds that we hadn't met the criteria. So you did expend those during the current year. I think that was the Cloud Splitter grant. So last year it was 20,000. This year we didn't have any. There's a concentration, and of your total loan portfolio, you have one loan that is 23.7% of that, and another loan that's 22%. So just let the reader know that. Tax uncertainties, since the EDC is a not-for-profit, there is a 990 that gets filed with the IRS. It's an informational return. And this note is letting you know that years 2021 and later are still subject to being looked at. And we also have that subsequent event note. So we would let the reader know here if there was anything going on between the end of the year and now that we should let you know about. Then we also have the Yellow Book report, which is our internal controls over financial reporting and compliance with grants, laws, and contracts. And Again, no deficiencies, no significant deficiencies, no material weaknesses, nothing to bring to your attention. So, been significant changes over this last few years, and moving to QuickBooks Online, I think was a very good move for you guys. The kind of the implementation is a little hard because when it goes in, not everything goes in beautifully, but I know Paul's been working and now Rachel has been working to get all that stuff cleaned up in there. But what's great about that is you're able to upload the supporting documents right to it. So you're able to see the
Invoices.
support, the invoices, the bank statements. It's like a dream for an auditor. So we were able to do quite a bit of the work, the majority of the work in the office, and have staff here working on that. So, and a lot less scanning on our part anyway. So it's, if you're keeping it up and scanning and adding it to the QuickBooks Online, it's always going to be right there for you to look at. And then, you're always getting the latest version. You're always, and there's always a backup. So, and you're able to look at it whether you're in Saranac Lake or Malone or wherever you are. So that's been a good deal. So and both Rachels were so helpful.
Cool.
And Paul.
Well, that goes without saying.
Oh.
Well, I said that already.
Any
So, any
I can-
questions?
When we get to, the particular organization, I can try to address some other questions that you might have.
Sounds good.
All set, Jim? You good?
Whenever you're ready.
I guess we're ready. We're all set. So thank you both
right.
very much.
Thank you.
guys.
Thank you.
Enjoy the meeting.
I'm sure it's going to be more exciting.
Enjoy the sunshine.
All right, thank you. You
Take care.
too. Bye-bye.
Bye-bye.
I didn't know they were listening. They weren't on the screen yet, but they can hear.
There.
Yeah, they got now.
Yeah, we're ready.
Yeah, that's about as exciting as Mimi's gold broth she drinks.
See,
Worse
come on, I just said it out loud. Worse than a banker.
Okay, now
Right.
with the conclusion of the auditor's report, we'll begin our regular monthly meeting. Oh, this is set up here. Well, the IDAs first.
Yep.
Fixed it. Like to call this regular meeting for the month of March. A week later than our normal time, only because of waiting the auditor's report, which we just heard. So our meeting will come to order now. Rachel, can you do the roll call, please?
Sherry Bouye,
Yes.
Jim Ellis,
Here.
Scott Gordon,
Here.
Melissa Mills.
Here.
Nate Manette,
Here.
Clyde Rabideau,
Here.
Nick Russell,
Here.
Motion to accept the agenda. As written or changed, depending on your preference. Hearing nothing to the contrary, we will accept the agenda as is. Could I have a motion to that effect, please? By Nick, second. By Melissa. All in favor of accepting the agenda as written, please indicate by saying aye.
Aye.
Opposed, nay. Period of public comment. Is there any public comments to be heard? There being none, we'll assume we're ready to go to item number 4, the approval of the previous meeting minutes. The meeting of January 8, 2025. We all received a copy of them in the email. Are there any additions, deletions, subtractions to the minutes as written? There being none, we'll assume the motion's in order. We have a motion to accept the meeting minutes of January 2025, please. Sherry, Nick?
Yep.
No discussion? Therefore, we'll move the question. All in favor of adopting the minutes of the previous meeting of January 2025, please signify by saying aye.
Aye.
Opposed, nay. Next, our committee reports.
Governance, I know Nick and Clyde and myself, we've had a couple different conversations regarding a couple different topics. Nothing to really report yet, but I'm sure there will be soon.
Well, I think the question is, what are the topics?
One of them mainly regarding future employees, you know, is pay rate, pay scales, pay rates, stuff like
Okay.
that.
Procedures.
Yeah,
for-
procedures.
Okay,
Yeah, we just haven't dialed it in yet.
oh, that's fine. And by the way, I'm pleased to see, you know, individual initiative is never a problem. I do think though that the only thing I'd caution us on is maybe letting us know what's going on would allow other members of the board to help you pitch in, whatever.
Yep.
But thank you, that's great, great job, governance committee. Audit and finance committee,
I don't think there's anything to report at this time.
okay, nothing to report.
Well, I would say though, is that we have lost our audit and finance committee chair and treasurer, Archie McKee, and so one of the things that we do need to do is to find a new treasurer and audit and finance committee chair, which reminds me, we forgot to introduce Scott.
Mea culpa. No, my fault.
It's as if
My
it's
fault.
always been here.
Yes.
He's been too quiet, but anyway, Scott is the director of the 4-H, our 4-H program, Franklin County
Cornell Cooperative Extension.
Cornell Cooperative Extension. Okay, welcome aboard.
Thanks.
We got a lot of work to do. And I'm sure we'll be glad to join in. Right, having you aboard, thank you.
There'll be a quiz on the financials.
Us absorbing, yeah. Mhm.
Better not ask me.
No.
Okay,
Jim, the only thing I would like to say is, you know, we've made a lot of efforts in trying to speed up the audit process, so the board isn't getting the audit the day of the board. We are trying to get back to where the audit and finance can look at this and have one-on-one conversations with the auditors a week before the board meeting. And that this discussion that we just went through and the time that was expended could be done with the committee. And then the committee could come and make a recommendation to the board to just simply accept the audit. So people's time is,
well, I think that's a great
you
idea.
know, and if the audit committee felt that it's still warranted further conversation with the auditor, then we would invite the auditors to the board meeting as we just did.
Good.
But so much of this is routine that it, you know, I think it can be best handled in the audit and finance committee.
Good.
As she said before, when they would come in, I mean, when I first was here years ago, the auditors would be on site 3 days. We got it down to 2 days. This year, we got it down to 1 because, as she mentioned, before we used to have file boxes and they had to go through the bank statements, they had to go through all of the vouchers and all of that, you know, because it's scanned and saved on our server. QuickBooks Online allows us to upload all that. So all of that information's uploaded and is part of QuickBooks, which they have access to on the online. So things where they would spend hours scanning, they no longer have to do because it's at their fingertips. So we're doing everything we can to speed that process up. I don't quite know what the delay was this year. But I will work to ensure that we have the audit to the audit and finance committee a week ahead of time. So we're not up against the clock like this, because I don't like the pressure of having to review something that I got the night before the board meeting either, so.
Thank you very much, and members of the committee, thank you for your
How are you doing with the treasuries? I know they're pretty stable right now. Have you changed your format or formula or your thinking?
So I'm now shifting. If I have opportunities, I'm going out longer term.
I would, yeah, sounds good.
Because, you know, the yield curve is starting to go north.
When you say out longer, how?
I don't go more than 12 months.
Oh, okay.
Yeah, if we go beyond 12 months, we get into T notes. Then there's a question as to whether we're investing. within the parameters of New York State's guidelines on
Right.
securing investments, because if something happened and we had to sell
Right.
a Tino that might be 2 years out.
You're laddering different terms, right? So
Right
that
now,
there
yes,
is liquidity
throughout the year,
alternatives.
like I have everything from 4 weeks to 26 weeks right now.
Okay,
Right.
so at no point, I mean, at any point, you have enough liquidity to do anything that we might have to do
Yeah.
as an organization, that
Yeah.
you would have to liquidate early any T-bills or anything. Okay,
Right, yeah.
okay. All right. Is there, I know I've asked this before, but forgive me, is there a policy that says what you can and can't, other than probably from New York State, right?
It's New York
What's
State.
appropriate and what's not appropriate?
New York State is extremely restrictive
Yeah,
on it. Now,
that's good reason.
there have been municipalities that have, you know, they'll get like a treasurer who thinks he's a guru in the stock market and will actually invest. Now, you're not supposed to do that according to general municipal law.
Right,
But the problem is New York State Comptroller's Office does not proactively look at situations. So if that person was flipped in for investing in Bitcoin,
right,
they're not, the state controller's office will not take any proactive approach on it. They'll wait 3-4 years
right,
when there's a loss. They'll come in and do an audit 3 or 4 years later
right.
and rate them up. So there's no proactive approach to that. And the only thing that they would do is just can't do that. There's no recourse.
Cause it doesn't seem like the audit company, they mention a CD or 250,000, or if you go in excess of 250,000 in a CD and say it's not FDIC insured necessarily, but they don't say anything about the T-bills, which I think is kind of odd.
Well, the T-bills are, I mean, what secures a CD for the most part are municipal bonds from different entities and stuff like that. The reason why we don't have that requirement is it's the Treasury Department. If the federal government fails on treasuries, then we got a lot bigger problem.
Right. Okay.
We're also guided by, and I send it out to everybody, I haven't looked at it in a while, Paul follows it, which is our own investment policy that
There is
is
something.
supposed to.
I mean, I'd like to buy some
Minimums.
gold to hedge.
Right.
You got a vault in there or something? I'm sure it's got one you can probably use.
Very good.
All right,
Is that-
thank you.
That's satisfy you.
Yes.
Okay.
Yeah, feel good, thank you.
Now ready for the treasurer's report?
Nothing really to report, Jim.
The CEO report. Next.
All right. So I want to divide my CEO report between the IDA and the EDC. Really, what I wanted to focus on is the annual report that is in front of you that maybe hopefully you've had a chance to look at really quick.
Okay.
We do our annual report all combined for all 3 agencies, and it's something that we do above and beyond the minimum that the state requires for us to submit by the end of March. And I don't want to go through each page, but I first want to recognize the you don't have one?
Oh, thank you.
Maybe he took one.
Oh, I got two.
Oh,
no, mine's-
thank you.
That's-
Thank you. I'm like,
So-
I don't know what you're talking about.
First of all, it's been really fun to kind of think through 2024 and where we were and where we've gone and the work we've been able to accomplish. We've got a great team in place. Rachel Karp's been a great addition. Her orientation, it seemed like took 2 weeks, not 2 months or 2 years. And that was good because the timing of that, her coming on board coincided with really getting going with the Resilient and Ready Home Repair Grant. That's been an all hands on deck effort. And so we got a great group. We've been working, trying to get from everybody all that we accomplished and try to summarize it in an annual report, which Kelly's put together and that you have in front of you. I want to just, for the IDA, focus really quickly on a couple pages. Number 1 is page 13, which has these little maps on it. Um. This, it's hard to show Franklin County the way it's. We've got our nodes of population centers, and then we have this big, beautiful area in between that's got nothing. So trying to show things on a map can be hard sometimes, so, but what we try to do is zoom in on our 3 largest communities and show how many projects we actually have going on and that we've accomplished over the last few years. This doesn't even include resilient and ready grants. We'll talk more about that in the EDC. But just real quick, as far as the IDA is concerned, we had 3 specific projects that we had action on last year. If you recall, we finally closed on the Glengarry Farms solar project in Burke. And that revenue was recognized in 2024. We did the branch commercial sales tax exemption back in December that was closed. And we also had approved the initial resolution for the Brookside Solar project that's in Burke and Chattagay. So that's in progress, but we got that officially started in 2024. So those are the three IDA specific projects that we worked on during 2024. And I will just mention also that once we approve a project, our work really is only beginning, because for the whole term of the project, we have to keep track of a bunch of information each year, and then also issue the invoices for the pilot payments, and then distribute those to the taxing jurisdictions. And so, as we all know, Maria had been doing that for a long time, and this year we did not have her doing it. And so Rachel came on board in October, and in December, she did most of the work, but Paul and I wanted to make sure we were understanding that process better also. And we were able to get all of our invoices out thanks to her, and we've received all the payments and then redistributed them on time. There was a glitch with the Chattagay School District, but we sorted that one out, and everybody paid on time, and we got everything redistributed. So
It's the difference between a street address and a PO box,
right,
unfortunately.
the check wandering around in Chattagay for a little bit. We took care of that. So that's all. Well, in the EDC meeting, I'll talk about a couple other elements of this plan, but that's my IDA report.
Thank you. Can we have a motion to accept the CEO report? Sherry, second. Melissa? Discussion. There being none, we'll assume that the question is moved. All those in favor of accepting the CEO report, please signify by saying aye.
Aye.
Old business. There being none, we'll move on to new business. New business, we have 2 resolutions. Beginning with resolution 2025-02.
Okay.
Recognizing the service of Archie McKee. I'd like to speak personally with this. I've known Archie for many years. I've known him ever since his time with the National Guard. We both served in defense of this great country. But anyway, it was great to do. He was a lot of fun. And then, of course, he was business experience at the old car agency, which my brother now owns. And then again, from our experience together when he was Franklin County Auditor, I always found Archie to be just a great guy to work with, as we all know. And we're sorry to lose him, but we understand when the time comes, have to do other things. So with that, resolution 2025-02, recognizing the service of Archie McKee. I have a motion to put that resolution on the floor. Sherry, second. Nick. Discussion. There being none, we'll assume that there has been a proclamation or what have you written up?
We were gonna print this and, you know, that reminds me, I'm gonna have a card for everybody to sign. We'll send it in.
Okay, are we all set so as far as? Okay,
Okay, we're all set.
that being the case, then, because we have that ready. We'll go ahead and do a roll call vote in just a moment. Well, let's do it now. Roll call vote, please, on resolution 2025-02.
Sherry Bouillon,
Recognizing service margin.
Yes.
Sorry,
Jim Ellis,
yes,
Scott Gordon,
Yes.
Melissa Mills,
Yes.
Nate Manette,
Yes.
Clyde Rabideau,
Yes.
Nick Russell.
Yes.
we'll now move on to resolution 2025-03, accepting the fiscal year 2024 audit financial report that we just heard. We have a motion? Motion? Nick, second? Melissa? Any discussion? Hearing none, we'll assume a motion's been moved. All those in favor, we'll do a roll call, excuse me, resolution 2025-03. Accept the fiscal year 2024 audit financial report, annual report, I mean, which we just heard.
Sherry Bouillon,
Yes.
Jim Ellis.
Yes,
Scott Gordon,
Yes.
Melissa Mills.
Yes.
Nate Manette,
Yes.
Clyde Rabideau,
Yes.
Nick Russell.
Yes.
we have some salary matters to discuss, and I'm not sure whether I should discuss them in this part of the meeting because they cover the three different components.
No, it should be an IDA.
Okay, then we'll do that. I would accept the motion to go into executive session at this point to discuss financial matters relating to our employees. Do we have a motion? Sherry, second, Nate? All in favor of going into executive session, please signify by saying aye.
Aye.
Opposed, nay?
Rachel.
Clyde, we're gonna create a meeting room and you'll have to just join the meeting room.
Okay, no problem.
I love the glasses, Clyde.
I like the hat.
It's sunny in Saranac Lake.
That's okay. I got hair, I don't.
Rachel, do you want me to sign these or do you want to send them electronically?
I have them all here too. so-
Oh, you have them
Yeah,
already?
I read
Okay.
them.
Yeah, go ahead. That's always- okay.
Sherry, do I need to stop the YouTube or does it do it since it's in a break?
No, it'll just go to a blank screen once. Yeah.
Okay.
So you're in the meeting room,
It's in.
they're in the meeting room now. It's time that pass it around. Or chief.
Did you say lunch?
You want to repeat, do you think we have to repeat what we just did to come out? Or is that on? No, okay,
We'll wait for Clyde. Officially. Okay.
There it is.
okay, we're now out of executive session, therefore. We got an agenda. Because of discussion in the executive session. I'm going to entertain a motion to, fill out the salary schedule for the, executive director for the years 2025, 2026. So. Could I have a, motion? To fill out, Nate? Second, Nick? All those in favor of coming out of, or to fill out the, salary proposals for 25, 26 for the executive director? The salary in 2025 to become 106,523. And in 2026, 115. If I'm correct? Any questions? There being none, we'll move the question and we'll do this on a roll call vote because it's financial.
Jerry Boyer,
Yes.
Jim Ellis.
Yes,
Scott Gordon,
Yes.
Melissa Mills.
Yes.
Nate Manette.
Yeah.
Clyde Rabidou,
Yes.
Nick Russell.
Yes.
thank you very much, everybody. Thank you. And congratulations, Jeremy. We recognize your hard work. And I suspect there'll be more of this to come as the governance committee also continues this discussion on employee evaluation and compensation. Thank you. Okay. I'm assuming, is there any public comment for this portion of the meeting, IBA? There being none, I'll accept the motion to adjourn the IDA meeting. Nate, second, Nick, all in favor of adjourning the IDA meeting,
Right.
please indicate, please note that our next meeting will be in April.